Welcome to Smart Wealth with Joshua.
Your daily stock analysis and catalysts talk. Today we're looking at Credo Technology Group.
If you find our talks useful, please consider subscribe, like, and comment underneath. Right now, if you ask, anyone on Wall Street about the AI boom, they immediately point to the chatbots, right? Or the software company.
Oh, absolutely. The flashy consumer stuff.
Exactly. But the real generational wealth, it's kind of quietly hiding in the back room of the data center, literally wrapped in copper wiring.
Yeah, the physical plumbing.
Right. While everyone else is fighting over these consumer-facing applications, the really smart money is slipping into the physical infrastructure of these massive hyperscale facilities. So our mission today is to unpack why a relatively, under-the-radar fabulous semiconductor firm is suddenly being called the absolute essential pick-and-shovel play of the entire artificial intelligence revolution.
Which is a huge claim, by the way.
It is.
Yeah.
And we want to show you why institutional investors are treating a recent drop in their stock price as a massive, glaring opportunity.
The fascinating part about this dynamic for you to consider is where the true bottlenecks in AI actually live. Because we hear endless conversations about GPUs, right?
Oh, constantly.
Yeah, the massive server farms required to train these large language models. But thousands of high-powered GPUs sitting in a room are functionally useless if they can't communicate with each other instantaneously.
Like zero latency.
Exactly. That communication layer is where Credo operates. They're building the critical connective tissue that allows the hardware to function as a unified supercomputer, essentially, without completely melting down the local power grid.
Which is a real risk.
Right.
And to truly grasp the scale of what is happening here, we need to look at the financial engine driving this narrative. Because the numbers, they're commanding serious attention right now.
No, they're staggering.
Right. We're looking at a company in an aggressive hyper-growth phase, fueled entirely by pure infrastructure demand. The hyperscalers, and by that I mean the titans like Microsoft and Google, they are rapidly adopting their core technology.
Specifically, their active electrical cables.
Yes, the AECs. And you see that adoption instantly in the revenue projections. For fiscal 2026, the estimated revenue is sitting at about $984.8 million.
Almost at that billion-dollar milestone.
Almost there. But the projection for fiscal 2027 is where the plot really thickens. The estimate accelerates to $1.38 billion.
Yeah, which is adding roughly 40% year-over-year growth at a billion-dollar scale. And doing that requires a flawless operational model.
It really does.
When you evaluate a company growing top-line revenue that aggressively, the immediate metric you have to check is operational efficiency. Because often, hypergrowth comes at the expense of just massive cash burn.
Right, they just light money on fire to get market share.
Exactly. But here, profitability is actually keeping pace. Their third quarter fiscal 2026 results demonstrated huge margin strength, which really proves their operating leverage.
And a lot of that is because of their business model, right?
Yeah, because they operate on a fabless model, meaning they design the really complex architecture of the chips, but they contract out the physical manufacturing to foundries.
So they don't have to build the multi-billion-dollar factories.
Right, they avoid tens of billions in capital expenditures. So as production of these connectivity cables scales up, a much larger percentage of that revenue flows directly to their bottom line.
Which makes their financial health metrics incredibly compelling. You've got a robust $20.26 billion market cap, healthy cash flow, and they're taking that cash and funneling it directly into heavy R&D.
Yeah, like their Robin optical DSP chips.
Yes, and the ZeroFlap optics platform, which are pushing the absolute boundaries of data transfer. But honestly, the single statistic that stands out the most to me, and this blew my mind, is their headcount.
Oh, the employee numbers.
They are doing all of this with just 253 employees.
It's wild.
It's insane. That's up about 32% year over year, which indicates, aggressive hiring of top-tier engineering talent. But maintaining a $20 billion market cap with under 300 people, that is the ultimate definition of an asset-light business.
It's a remarkable ratio of revenue per employee. However, any investor pulling up a stock chart right now is going to confront a valuation that requires some serious justification.
Yeah, let's talk about the elephant in the room there.
Because the trailing price-to-earnings ratio is currently sitting at 424.33x.
Ouch.
Yeah. And looking forward to late 2025, the forward PE is nearly 85x. That level of premium pricing suggests the market believes this company is virtually untouchable.
Right, and with numbers like that, I'm looking at an 85x multiple and thinking, okay, this has to be priced for absolute perfection.
That's a steep climb.
A valuation that traditionally signals an AI hype bubble to me. Like, if they stumble even a millimeter, doesn't a stock with that kind of multiple just plummet? Are the underlying earnings actually capable of catching up to the current stock price?
That's the core risk you have to weigh as an investor. A high PE ratio is a trap if a company's growth curve begins to flatten out. But the analyst revisions offer a very different narrative here.
Oh, so.
Wall Street quantitative analysts are actively revising their pro forma earnings per share estimates upward. They're bumping them up by 5 to 6% for fiscal 2027 and 2028.
Okay, so the underlying math is actually improving.
Exactly. Those revisions indicate that the earnings are accelerating even faster than the previous bullish models predicted. The gap between the earnings and the valuation is closing rapidly because the hyperscaler adoption rate is just massively outpacing initial forecasts.
Which brings us to the really obvious question, I think. What is to stop a massive competitor from just, reverse engineering these cables and crushing that profit margin?
Right, the moat.
Yeah, to maintain an 85x forward PE, a company needs an impenetrable moat. They need something the massive tech monopolies can't just easily copy or build in-house.
Well, the competitive moat here relies on two really distinct pillars. Its highly proprietary silicon design, combined with a completely vertically integrated product strategy.
Okay, break that down for me.
So the foundational intellectual property is their low-power SerDes technology.
CRDs, right? SCRDES.
Yes, it stands for serializer deserializer. In simple terms, when you have massive amounts of parallel data coming out of a computer processor, a SerDes chip converts that parallel data into a single lightning-fast serial stream.
So it can travel down a wire.
Exactly. And then the chip at the other end deserializes it back into parallel data for the receiving processor.
Got it. And instead of just manufacturing that little SerDes connectivity chip and selling it to some random cable manufacturer, Credo flipped the business model.
They absolutely did.
They essentially created the market for the entire active electrical cable.
Yeah.
They decided to sell the full assembly, the copper wire, the physical connectors, and the integrated silicon chips, all functioning as one unified, optimized package.
And that vertical integration is a masterstroke in creating customer lock-in. By providing the entire cable assembly, their proprietary technology becomes deeply, deeply embedded into the physical architecture of these billion-dollar GPU clusters.
So you can't just swap a piece out.
No, exactly. When a hyperscaler designs the layout of a massive data center around the specific performance metrics and physical dimensions of these exact cables, swapping them out for a generic competitor later introduces massive switching costs and operational risk.
It's like, think of a modern AI data center like a city's water grid, right?
Oh, I like that.
You are trying to push an absolute tsunami of water, which represents the massive data sets required for AI training. And you're trying to push it through cheap plumbing without bursting the pipes.
Right.
In this industry, that challenge is known as the bandwidth power cost trilemma. Historically, data centers had two really flawed options. The first option was passive copper cables. Copper is cheap and it requires zero electricity to move the signal.
But it's limited.
Very limited. It's like a leaky pipe. The electrical signal degrades incredibly fast. Passive copper simply cannot handle massive data speeds over any meaningful distance. It taps out at maybe, 1 or 2 meters?
Yeah, barely enough to reach the next server over. And the second historical option was fiber optics. Optical cables use lasers to transmit data as light.
Which sounds super fast and futuristic.
It is, and they can carry an infinite amount of data over miles without degrading. But they are wildly expensive, and more importantly, the optical transceivers at both ends require a massive amount of electricity just to power the lasers.
Wow.
Yeah, so when an AI data center is already struggling to pull enough electricity from the local grid just to run the GPUs, adding thousands of power-hungry optical cables becomes an existential problem.
Right, which is where the third option completely changes the math. With the active electrical cable, Credo embeds their low-power chips directly into the ends of a traditional copper cable.
Making it active.
Exactly. It acts like a digital pump station. The chip actively cleans up the signal noise, boosts the transmission, and pushes it further. And the critical metric here is that they can extend copper transmission distances up to 7 meters while maintaining superior power efficiency compared to optics.
And, 7 meters might sound like a completely arbitrary number.
Yeah, like why 7?
Right, but in data center architecture, it changes everything. 7 meters is roughly the exact distance required to wire servers at the top of a rack all the way down to the switches at the bottom, or even across to adjacent racks.
Also, it perfectly fits the physical layout.
Exactly. By pushing copper's capability out to that specific distance, hyperscalers can wire up massive clusters of servers without ever having to switch over to those power-hungry optical connections.
That's huge.
It really is, because power constraint is the single biggest bottleneck capping AI development globally right now. Extending that copper range essentially gives data centers a massive portion of their power budget back.
So they are literally solving the physics equation of power versus distance. They aren't just selling a commodity part, right? They are an enabling technology.
That's the perfect way to phrase it.
Because without this specific cable architecture, the next generation of AI infrastructure
Right.
simply cannot physically operate within the power limits of modern electrical grids.
And their underlying technology continues to evolve to solve the optical side of the equation as well.
Yeah.
Because you mentioned the Robin DSP chips and the zero-flap optics earlier.
Right.
DSP stands for Digital Signal Processor. When data centers do have to use optical cables for longer distances across the facility, the signal still needs to be translated from electrical data to light, which introduces noise and errors.
It's never perfect.
No. So a DSP is essentially the mathematical brain that cleans up that high-speed signal. By developing their own low-power DSPs and dense optical platforms like zero-flap, they're capturing the entire connectivity market, both the short-haul copper and the long-haul optics.
Okay, so we've established a staggering growth rate. We have technology that fundamentally alters the power constraints of global data centers and deep integration with the biggest technology companies on Earth.
Yes.
But if the fundamentals are this solid, we really have to look at the massive elephant in the room regarding the stock price.
The recent drop.
Yeah, because financial headlines over the last few weeks have been throwing around the word meltdown. The stock suffered an 18.4% drop year to date, trading around $116.88.
It sounds bad in isolation.
Right. How does a company enabling the AI revolution drop nearly 20% in a few months?
Well, separating long-term structural value from short-term market psychology is critical here. To really provide context for you, over the last 3 years, this stock experienced a monumental 1,325.4% rally.
Okay. Yeah, that is a rocket ship.
Exactly. Even factoring in the recent year-to-date drop, the stock remains up 148.6% over the trailing 12 months alone.
Wow.
So a nearly 20% drop from absolute peak highs naturally triggers dramatic headlines. But from a quantitative perspective, this is a textbook consolidation phase. It's a volatility squeeze, basically shaking out short-term speculative capital.
And the phrase quantitative analysts are using right now is contrarian bullish. They're noting the stock is oversold in an uptrend. So it sounds like the institutional investors, the smart money, they are treating this not as a structural failure, but as a breather. Because Goldman Sachs recently initiated coverage with a buy rating and set a $165 price target.
Which is substantial.
It is. If the stock is hovering around 116, that implies roughly a 42% upside.
Meanwhile, Bank of America also maintained a buy rating, though they did recently adjust their price target down from $200 to $160.
And that's interesting to me because a downward target adjustment, even while maintaining a buy rating, often signals a little bit of caution. If the company is hitting its revenue marks and the technology is dominant, why would Bank of America lower the target?
It's all about the macro environment.
Does the macro environment really dictate that much? Because we are seeing serious headwinds with the Middle East conflict and global energy cost spikes dragging down the entire semiconductor sector.
That's exactly it. Bank of America's adjustment was explicitly tied to industry-wide multiple compression, which is entirely divorced from company-specific execution. Think about it. Chip manufacturing is a highly energy-intensive, globally distributed process. When geopolitical tensions escalate, particularly in energy-producing regions like the Middle East, global energy costs rise, and supply chain anxiety goes through the roof.
And investors get spooked.
Right. Consequently, investors demand a higher risk premium. They become completely unwilling to pay peak valuation multiples for any technology stock. So PE multiples compress across the entire sector.
Even if the company itself is doing great.
Exactly. Because Credo is technically categorized in the semiconductor sector, algorithmic trading and sector-wide ETFs pull the stock down with the broader group, even though their fabless model insulates them from a lot of those direct manufacturing costs.
So the broader market catches a geopolitical cold and the stock sneezes, regardless of the underlying business health.
That's a great way to put it.
And this plays directly into the meltdown's a gift thesis that's circulating among institutional buyers right now. They view a macro-driven sector-wide sell-off as a rare accumulation zone.
Yeah, they're buying the dip.
Right, they can buy into the AI infrastructure supercycle at a 20% discount,
Yeah.
knowing the structural demand from hyperscalers hasn't diminished at all.
And recognizing an accumulation zone requires mapping out the specific near-term triggers that could reverse that multiple compression and ignite the next growth cycle.
So what are the catalysts?
The calendar ahead is actually packed with concrete catalysts. The most immediate is their fourth quarter fiscal 2026 earnings report, which is scheduled for late April or early May as their fiscal year concludes on May 3rd.
Okay, so right around the corner.
Yeah, and analysts are looking for undeniable continued acceleration in cable revenue to validate that premium multiple.
And beyond the earnings ledger, there is massive industry momentum coming out of the Optical Fiber Communication Conference, OFC 2026.
Oh yeah, that was huge for them.
This is the premier global event where hyperscalers evaluate next-generation networking hardware. The company actually took home major industry honors for their new Bluebird DSP and their demonstrations of 800 gigabit and 1.6 terabit technology.
Which is mind-boggling speed.
Right. Moving data at 1.6 terabits per second means transferring entire libraries of digital information in a fraction of an eye blink. In this case, those demonstrations are not just vanity projects.
Not at all. Demonstrations at OFC serve as the precursor to massive commercial contracts. The market expectation over the coming months is that those 1.6 terabit capability demos will convert into tangible design wins.
Because the hyperscalers need it now.
Exactly. The hyperscalers are currently architecting the data centers that will come online in 2027 and 2028. They need to lock in suppliers who can handle those future speeds today.
Which leads perfectly into the unconfirmed speculation that is currently driving a lot of institutional whispers. We know their technology is deeply embedded with Microsoft and Google,
Right.
but financial analysts continuously reference growing hyperscaler adoption without naming specific corporations. The predominant rumors point toward Amazon Web Services, AWS, or Oracle officially joining the client roster.
Which would be massive.
Right. If a titan like AWS formally adopts these active electrical cables at scale, that transitions from a speculative rumor to a transformative fundamental catalyst.
Because expanding the hyperscaler client base validates the technology as the definitive industry standard rather than just a bespoke solution for Microsoft. But another, even larger speculative catalyst constantly provides a floor for the stock price.
M&A, mergers and acquisitions.
Yes, exactly.
Because looking at the structure of the semiconductor industry, which is currently undergoing just rapid and aggressive consolidation, this company looks like a uniquely shaped, highly valuable puzzle piece.
Holy.
They possess heavily protected intellectual property in low-power SerDes, and they completely dominate the active electrical cable market. It seems entirely logical that a massive networking giant or one of the major chip manufacturers would attempt to acquire them outright.
It makes perfect business sense.
Right. And the motivation wouldn't just be integrating the technology, but explicitly keeping that vital IP out of the hands of direct competitors.
Yeah. While an M&A scenario is logically sound and offers a nice speculative premium, sophisticated investors focus on confirmed fundamental catalysts.
Sure.
The most potent catalyst for the entire semiconductor sector right now is macro de-escalation.
Just things calming down globally.
Exactly. Any stabilization in global energy prices or geopolitical tensions would immediately relieve the pressure causing that multiple compression. High-quality, hypergrowth stocks with pristine balance sheets are historically the first to experience aggressive relief rallies when macro pressures subside.
So bringing all these threads together really requires a definitive framework for weighing the risks against the projected upside. If we are looking at this from a wealth-building perspective, what is the absolute worst-case scenario? Like, what constitutes the bear case here?
The bear case is entirely predicated on valuation vulnerability and hyperscaler capital expenditures. An 85x forward PE leaves absolutely zero margin for error.
Right, it's a tightrope.
Yeah, if the current macro overhangs persist longer than expected, multiple compression will continue to suppress the stock price. But the fatal risk is a sudden deceleration in AI capital expenditures.
If they stop spending.
Exactly. If Microsoft, Google, or Amazon decide they have overbuilt and they tack the brakes on constructing new data centers, the projected 40 to 50% revenue growth will just evaporate.
Ouch.
And without that explosive top-line growth, a stock trading at 85 times future earnings will face A very severe correction.
Yeah, a valuation that high represents a steep cliff if the fundamental growth thesis breaks.
Mm,
But the mitigation to that risk seems to be the structural nature of the AI revolution itself.
right.
These risks appear overwhelmingly tied to temporary macroeconomic cycles, rather than flaws in the product or the business model. The fundamental demand for high-speed connectivity, the absolute necessity of solving the bandwidth and power bottleneck that is a secular bull market. Artificial intelligence models are expanding exponentially, demanding vastly more speed and power efficiency, which essentially mandates the use of this specific technology.
And weighing that macro vulnerability against the structural necessity of the technology yields a bullish score of 8.5 out of 10.
Wow, 8.5.
Yeah, it's strong. But the appropriate investment horizon here is not short-term trading. Capturing the fiscal 2027 and 2028 growth cycles requires a 12 to 18-month view.
You have to be patient.
Exactly. The core thesis is straightforward. This company is solving the most critical power and connectivity constraints inside the world's most valuable real estate. Despite a nearly 20% year-to-date correction, the underlying fundamentals project massive revenue expansion and widening profit margins.
So the math is on their side.
Yes, the risk-to-reward profile remains highly asymmetric in favor of the upside.
So the primary wealth-building takeaway for you today is the importance of holding through volatility when the underlying thesis remains intact. You are positioning capital to capture a long-term generational infrastructure upgrade.
It's a long game.
It is. This is an investment in the foundational plumbing of the future economy. Navigating a meltdown headline requires recognizing when the market is simply clearing out short-term noise, leaving a really clear runway for the fundamental mechanics to drive the next wave of compound growth.
And institutional investors utilize these exact periods of macro-induced panic to build positions in companies with irreplaceable technology. Understanding the difference between a fundamentally broken company and a compressed market multiple is the defining characteristic of successful long-term capital allocation.
Perfectly said. I want to leave you with one final scenario to consider before we wrap up. We detailed how these active electrical cables are rapidly establishing themselves as the absolute standard plumbing for the global AI build-out.
Right.
If this proprietary technology is the only viable method keeping these massive data centers from completely exhausting their electrical grids, just consider the implications for the balance of power in the broader tech ecosystem.
It's profound.
If a single titan, an Amazon, a Microsoft, or even an NVIDIA decides to execute that M&A strategy and acquires the company outright, they suddenly control the patents to the exact cables making next-generation AI physically possible.
Which changes everything.
How deeply would that bottleneck the development cycles of their competitors? It is a fascinating high-stakes game of chess happening right now in the physical layer of the internet. Thank you so much for joining us for this exploration on Smart Wealth with Joshua. Understanding the fundamental mechanisms driving these market movements is exactly how you stay ahead. We will see you next time.